This is EnRich Your Life, a podcast about financial health, all things investing, life planning, and smart decisions with Richard Limegruber.
Hello and welcome to EnRich Your Life podcast. I am your host, Rich Limegruber. And today we're going to be talking about something that every business owner probably has thought about in the past. And if you haven't thought about it and you are a business owner, you want to listen to this podcast. It's all about setting up a retirement plan for your business. And if you've had a retirement plan already and you think there might be an opportunity to expand what you've already done, we're going to go over all those opportunities for you today. We are starting a new Prosperity for Business series on our podcast. So we're going to be adding a lot more business owner value content to this podcast. So please check back in, make sure that you're getting all the great content that we're providing to our listeners. Today, we're diving into a topic that impacts every small business owner. Whether you're a sole entrepreneur or managing a team that is growing in leaps and bounds, which we all hope they are, you probably thought about your retirement plan. We know when structured well, a retirement plan can attract talent, retain employees, reduce taxes, and build long-term wealth for everyone who's participating. But the rules are complex. And the landscape continues to evolve, especially with some of the major updates on the Secure Act 2.0 and now the Big Beautiful Bill Act of 2025. So to help us break this down, I'm joined today by someone who lives and breathes plan administration, and that's Brad Scherer. He's a third-party administrator with a deep background in compliance, audit, and financial controls. Brad began his career as a sales tax auditor for the state of New York. He went to Deloitte's financial services audit practice, served as a controller at Goldman Sachs, and since 2017 has worked as a TPA, or a third-party administrator, alongside his father, who brings more than 45 years of experience in the retirement plan industry. Today, we're going to discuss how to choose the right plan structure, what changes when you hire employees, how to avoid IRS and Department of Labor problems, and why every business owner needs a clear strategy for retirement planning. So let's jump in, Brad. Are we ready? Before we start off our conversation, Brad, I always find it interesting to learn what drives people like yourself and why you got into the business that you're in today. So can you give us a quick story of how do you become a TPA? It sounds so exciting.
Hey, Rich. Yes. Thanks for having me. Believe it or not, they don't have a major in college as a third-party administrator.
No? Okay.
So I always knew I wanted to be in the business field, and I was a business major, and I was kind of told by a couple of mentors, accounting's a great place to start because with an accounting degree, you have a great base for numbers and financials, and you can really go anywhere. So that's kind of the route I went. And even though my father's been doing this for a long time, I was kind of looking for my own way in life, really, to start off. And I graduated in 2009, right as the financial crisis was in a big swing.
Oh, yeah.
And jobs were limited at that point. So as you mentioned, I started my career with New York State Department of Tax and Finance as a sales tax auditor. Yeah, it was really cool to be able to see kind of what goes behind the scenes from a regulatory body and know what they're looking for and make some connections there. So
sure.
That was great. But I always knew I wanted to work for the Big Four. And right kind of as we came out of the crisis and people started hiring again, I moved to Deloitte's audit practice, which I was in for 4 years, and it was a great background, and I met some amazing people, and I still think the way that I talk to people and I craft emails all came from that knowledge base. So maybe not necessarily the audit knowledge, but just how to be a financial professional in the world.
And what I always say is the more experience you have, you can get right to the point. Like, here's the value added. Here's why you want to work with me. And here's the information that you need. Let's get over all the BS, right?
Right.
Kind of stuff.
Exactly.
Right.
So I ended up leaving the accounting field, realized it wasn't for me. And that's when I came to work with my father and been doing this for about 8 years now. I love it. I love to be able to work with small businesses and kind of help them navigate the rules so it works well for them, because these really are great benefits for owners and employees if they're used the right way.
Right. Yeah.
Obviously, if they're not, they could cause a lot of headaches. And it really drives me on a day-to-day basis to be able to work with all my clients, whether they're in the financial field or they're a plumber or they're in construction, wherever it may be, we have clients in every industry, and it's really rewarding. And they realize that what we do is a value add to them, and that's what drives me.
Yeah, and so no matter what business you're in, right, you all have profits. And we always say as a financial advisor, the best thing I could do for a client is help them reduce their taxable income, right? And at the same time, be able to save, maybe tax deferred, maybe after tax, but save on taxes, retain the employees, right? So offer something that your employees can also participate in. And that's why I thought it was so important to get in on this conversation with you. And I full disclosure, I've been working with you now for at least a year through the firm that I work with, and you always do a great job. So I appreciate you coming on today. So let's talk about establishing business goals and planning for retirement. Which one is always going to be right for the business? Because it's never a yes or no answer. It's never a defined, yes, this is the one that you should be using. It all depends on what the business owner wants, right? What factors should a business owner consider when determining the goals of a retirement plan?
The goals are where you have to start. And you already mentioned a few before. Plans come about from a number of different scenarios. You are looking to accumulate wealth to live on in retirement, maybe a supplement Social Security or supplement any other income you have. You're looking to attract and retain talent. It is a benefit for the employees. You are looking to now comply with 15 states and soon to be 10 more states that are requiring companies to have these plans or use a state-sponsored IRA. And the fourth one, and probably the biggest one in our world, working with small business owners, as you mentioned before, is the tax advantages.
Yeah, great.
So, and then furthermore, you want to understand what the cash flow of the business is. You want to understand what the budget is. You want to understand what the employee demographics are. And all of these factors will help you design the plan, which is the foundation of the plan. Now, it's not to say you can't redesign the plan or change things or amend things as you go along, but the design of the plan is the foundation of how things are going to work.
So how do owners' objectives such as saving for their own retirement versus offering an employee benefit impact that plan design?
So the IRS and the DOL have a lot of rules, as you can imagine. And depending on your goal will depend on how you design the plan, as I mentioned. So if the goal is to maximize owner contribution and minimize employee contribution, that will be set up one way, as opposed to the other end of the spectrum, where maybe owner or highly compensated employee do not want to contribute and do not want to be part of the plan, and the plan is just for non-highly compensated employees. You can design it a completely different way than that.
The next thing I wanted to talk about is how often should a business reevaluate whether its current plan still aligns with its goals. And you had said that you can change things. So sometimes I meet with new prospects or new clients, and when we're going through what they're doing for their business, it turns out it was set up maybe 15 years ago when they were a small little nimble shop and it was just him and his wife, right? Or her and her husband. And now all of a sudden you hired 3 employees and you're starting to do really well, and they don't realize that you should be probably looking at updating your plan to something maybe a better option, right?
100%. I would say at least on an annual basis. It's a great idea to sit down with your administrator and really speak, even if nothing has changed. Just a good opportunity to kind of speak about if your goals that you started the plan are still your goals now.
Right.
And of course, on a proactive basis is always better. I find it best to try to communicate and sit down with my clients before the end of the year, because there's still the opportunity to fix things or change things before you've hit certain points of the year.
Okay.
But you definitely want to do it at least annually. And if things are changing, you want to do it more than annually. If maybe there's a divestiture or there's an acquisition of a business, it's a great time to sit down and see how that affects your plan. If employee demographics are changing, maybe older employees have now retired and you're bringing on younger employees. So the profit sharing contribution you've been making doesn't work anymore. You have to change things there.
Yeah, and so you brought up a good point, and I think ultimately for somebody like you or any other third-party administrator, just like a tax accountant, right? Don't call them on April 14th asking them to do your taxes, right? It's just like, yeah, good luck. Same thing with a TPA. When would be the right time to say, hey, I got to reach out to my TPA. I got to reach out to Brad and tell them about all these updates. I mean, when's your busy season?
Well, it's always good to do it on a proactive basis.
Okay.
If, for example, if you are going to have a merger of a business, please come talk to me before the merger comes through. Right. So maybe there's something that I can speak to you that needs to go in the contract of an acquisition. Let's say you're doing things as an asset purchase or an equity purchase, or maybe there's a liability. The company you're buying from has a match that they haven't made the contribution yet, and now you're taking on the liability of this company. Maybe that's something you want to put in the contract to have the company pay for before the acquisition goes through.
Oftentimes I hear business owners that they wish they set up a plan sooner. Maybe they just never set one up. Maybe they didn't have enough cash at the time, or maybe they just didn't realize that you could do that, and they were putting into a traditional IRA, saying, I wish I could save more money for my retirement. Have you seen any challenges business owners face when they wait too long to establish a plan?
Well, I've heard all the excuses why not to do it now. I would say the biggest problem in waiting, as you know very well, is compounding of interest and time value of money. You'd rather have your money working for you rather than you working for it. So the sooner you get the plan started, the sooner you get your money in the market, the more your money can work for you. I'm sure you know the rule of 72 very well.
Absolutely. The rule of 72 is great.
Rate of return times number of years is how long, equals 72 is how long it takes your money to double. So the more you can get the money in your market, in the market quicker, the more that your money can double over time. So
I use that reference all the time. It's been on this podcast several times. I explain it as you take 72 and you divide it by your rate of return, and that's how long it's going to take you to double your money. Right? So if it was a 10% return annually, and it'll take you 7.2 years to double your money without adding anything into it.
When I talk to employees about enrolling, then they ask me, when should I get started for retirement? My answer is always yesterday.
And it should be, right? Because obviously there's a lot of benefits to setting up a retirement plan, not only for your income today, but also for your future and how much money you're going to have there, right?
Exactly.
So business owners have so many options, Brad, and we all know those options. You and I, we talk about them all the time. So can we briefly break down some of the plans that are available? And obviously we all know that there's traditional plans, right? The traditional 401k before tax dollars getting saved and on 100% taxable when you take it out in retirement. But now we have this new introduction of the Roth that uses after-tax dollars. So most of these plans now have either traditional or Roth capabilities. But let's talk about the plans. We have IRAs, simple IRAs, SEP IRAs, solo 401ks, regular 401ks, and then we have those good old cash balance pension plans, I think. Did I get them all? Or
Yeah, for the most part. You hit, you hit the big ones. The biggest difference between all those plans are the dollar limit you can put in. As you go from IRAs to much more complicated plans, 401k plans, cash balance plans, you'll have a higher dollar limit you can put in on an annual basis. As you graduate to the higher dollar limits, it's a bit more complex to administer, but they're more customizable and it's more flexible. So the more that your business needs customization of a plan, the more, or the higher limits, the more you should think about going into the 401k and cash balance plan. Yeah. If you are a solo entrepreneur and you have a high income, a SEP may work for you. But if you are an S Corp or a C Corp and your income isn't as high, maybe you want to think about a 401k plan because you can get a higher contribution into a 401k plan than in a SEP. So a lot of differences between them. Contribution limits, eligibility, and customization are probably the biggest factors.
And then one of the other things I always bring up too around all this is when you're able to add a contribution. So as an example, within a solo 401k or a 401k, you as the employer can add up to December 31st of each year. But once December 31st ends, that's it for you as an employee making a contribution, whereas your business after the end of the year can always make a contribution up until when the business files the taxes as a profit sharing contribution,
Correct.
right?
Correct.
So I think that's one of the other things, if you want that flexibility of being able to add more, because some might say, well, I have to figure out how much money I have left at the end of the year to know how much I'm going to be able to put in. And that's where the profit sharing side of it, this all comes in.
And a lot of times you're working with your accountant maybe in January, February, or March, and that's where for the first time you're understanding what your tax liability may be or how much you owe in taxes for that given year.
Right.
And then hopefully between myself and your accountant and yourself, we can give you different options about, if you put money into a plan and how much money you did put into a plan, how much lower your taxes owed could be.
So the other thing is the amount of contributions you just mentioned. IRAs, as without talking about, after 50 excess contributions, 7,500 in 2025. I think it's going up to 8,000 next year, right? Or 7,500 next year. And then with a 401k, you could put up to 23.5 into as an employee, and then if you're over the age of 50, obviously you could put another 7,500 away as well.
Correct.
That's changing. Secure Act 2.0, right?
Yes.
Is changing that for anybody over a certain income limit.
So if you made over $150,000 as a W-2 in 2025, and you're over age 50 in 2026, your Roth, your catch-up contribution now needs to be made as a Roth.
Okay. And that's important to business owners. And the reason is because if you're offering a plan that does not have a Roth capability,
Correct.
then the person who's over 50 is not going to be able to contribute that extra money.
Correct. So you want to work with your administrators now to, as we mentioned before, being able to amend the plan to either adding a Roth capability, or maybe you decide, I don't want to make a Roth contribution, so I just won't make a catch-up contribution this year. I'm hearing that a lot from some of my clients because they're using their plan solely for a tax deduction, and if they're not getting one, they're at the level where they need to be for retirement. So adding more funds doesn't necessarily matter to them. So it's really an individualized conversation that you need to have.
And that gets me to the point of what role does a TPA play in designing, help maintaining, and monitoring your retirement plans? And because someone can actually go and set one up and not use a third-party administrator for a lot of the things. Can we express the value that you provide and for the things that you're doing throughout the year?
Our goal is to ensure that the employer has to put as little time in this as possible and focused as much time on their business. So we want to take everything off their plate that we possibly can. So we do everything from plan design to compliance testing, to calculating the contributions, to preparing the reporting documents for the IRS and potentially DOL, and tracking eligibility, and everything in between. We want to ensure that your plan is running as highly efficient as possible and that you are spending as little time in this as possible.
And the reason for that is something I wanted to bring up is what happens if your plan is out of compliance? Right? You have the Department of Labor looking at you, you have the IRS looking at you. There's a lot of people looking at your books, looking at everything that you're doing. And I always say you want the least amount of eyes looking at your books throughout the year.
Correct.
And that's why you want to stay in compliance, correct?
Correct.
So can you give us maybe some examples of things that you've seen, that mistakes that were made that you had to come in and kind of hopefully rescue the day?
One of the biggest mistakes I've seen right now is if you're working with a company that is doing your plan document that is not an actual TPA, just a system that you're putting in money and they're spitting out a plan document, and it's a solo 401k. You do not have to file a 5,500 until you are over 250,000 in assets. Yep. The problem is no one is reminding you when you're getting to that level of 250,000 assets, or you hire a common law employee, that you now need to file a 5,500. So I'm having people come to me that they haven't filed 5,500s in the prior few years that they've needed to, because they don't have a TPA that they're working with that's kind of nudging them to say, hey, you now have to do this. So then you have to work with the volunteer program to raise your hand, pay penalties, file the previous 5,500s to get you on shape for the next one. Because no matter what, even if you don't go over 250,000 in assets ever, you will still need to file a 5,500 in your final year.
And those are the things that you will be able to help somebody look out for.
Just one example.
Right.
Another example I see, a common pitfall is if you own more than one company and you're what's called a controlled group of corporations and you have employees in your other company, but you're not including them in the retirement plan because you just didn't know.
Right.
And you are now, maybe the IRS or the DOL knocks on the door and they find this out. And now you are going to have to pay penalties and you've now failed compliance testing because of this. So we know the right questions to ask because we're asking them all the time.
Mm-hmm.
And we know you personally. So maybe there's something that you've said that will make us think to ask a certain question that you may not think to just tell a computer.
And there's ways that you could set up basically making sure that people stay in compliance, like having a safe harbor contribution, perhaps, right? So can we talk a little bit about those safe harbor contributions?
Yes. So if an owner or a highly compensated employees are contributing to a plan.
What would you define as highly compensated?
That number changes every year.
Okay.
So right now it's about in the $155,000 range.
Okay.
Depending on what year you're talking about. If you have highly compensated employees, then you have to pass certain non-discrimination testing. Most small businesses are going to fail these testing. The two big ones being the top-heavy test and the ADP-ACP test. If you're going to fail these tests, then the remedies are you're either going to give money back as the owner, or you're going to have to make a contribution. So what a safe harbor does is a safe harbor avoids you having to even perform these tests. There are two different types of safe harbor contributions. They're both an employer contribution. One is a 3% non-elective to all individuals who are eligible for the plan. The other one is a safe harbor match, which is 100% up to the first 3% and 50% of the next 2%. So if a non-highly compensated employee is contributing 3% of their salary, they'll get a 3% match. 4 gets you 3.5, 5 gets you 4, anything above 5 still gets you 4. So using one of these two options, depending on your demographics of the staff and who is contributing, what kind of contribution you want to do, will avoid having to perform these non-discrimination testings and have problems in future years.
And is that something these tests that you have to perform, is that something like the IRS looks at and says, hey, we want to make sure that you're doing these testing, and if you haven't, what is the ramification?
You must do these tests. If you're not doing a safe harbor contribution, you must do these tests.
Okay.
And if you're failing them, then as I mentioned before, there are a couple options. The owner either takes money out of the plan, which depending on the time that they do that, could be gains giving back or even potential penalties. Makes it harder for your accountant as well. Or, like I said, you're going to have to make a contribution for your staff anyway.
How can inaccurate or incomplete employee census data create risks for the plan?
It's the basis of everything. If you don't have accurate data, an administrator can't do their job, and you can't even prove that a plan is compliant or not. If you have incorrect dates of birth, you have incorrect dates of hire, you have incorrect hours, then no test can even be done.
Right.
So you're not even at step one without correct data.
So that's similar to what you put in is what you're going to get out of it. If the data you're putting in is wrong, you're going to get bad data back out.
And as I mentioned before, it's not even necessarily some of the data that you know. It's some of those things that TPAs know to ask in terms of, do you own another company? Do you have income elsewhere? I've seen a lot of issues where someone has they have a day job with a W-2, and they have their plan in a side gig, and they are contributing to their 401k plan at their day job, and they also want to max out their 401k, their solo 401k. But you can't, because the 23.5 maximum is per person.
Right.
So the TPA has to know to ask those questions so you can subtract how much you put away into your 401k, your day job, to know how much you have left to put in your solo 401k.
And that's when I usually get a phone call. And that's the worst news I can hear is it's called an excess contribution removal, right? Removal of excess contributions.
Yes.
And that's when the custodian has to get involved or whoever's managing the funds for you. And it becomes a nightmare. It really does, because now you have to look at how much money, when you put it in, how much money that contribution actually made. As important as you and I are as advisors to small business owners, we must understand all the nuances of the plan that we've kind of gone over, right? And we also have to pay attention to any new updates and changes. As I mentioned earlier, we had the Secure Act 2.0 with this new catch-up contribution change coming in this year that most people didn't even realize happened when the law went into effect back in 2022. But we also have some new changes with the Big Beautiful Bill Act that was just passed into law on 4th of July, retroactive to January 6th. What Secure Act 2.0 provisions have the most significant impact on small business retirement plans?
So we hit on the Roth catch-up earlier in the podcast. Yep. Another change is what's called the long-term part-time employees, where the IRS said that you can exclude individuals from a plan if they don't work more than 1,000 hours in a year. Now there's a provision where if employees work a certain amount of hours for a certain amount of years, and they're part-time, they're not 1,000 hours, but more than 500, they can be included in the plan, and they'll be able to defer for themselves. Now, these individuals won't get an employer contribution, but it's just another thing to track.
Another layer.
For the owner to, if you have hourly employees, tracking hours and knowing who is eligible for what type of contribution. But it's not all bad. They've also added some startup credits, which is helping plans become more affordable, especially in the first couple of years, being able to offset TPA cost, record keeper cost, financial advisor costs, and even some credits to offset some of the employer contributions, safe harbor or match contributions that can make for the first couple of years.
So the government recognizes that this is not easy. So they're incentivizing businesses to say, hey, we could save you even more money if you do this now, right? So they're incentivizing you to get this done. And so that's one of the things I'm glad we brought up, because, it all depends on the size of the plan and how much money that you're going to be able to get back.
Yeah.
Where can somebody find that information?
Right on the IRS's website.
Okay.
They'll tell you. It maxes out at a certain dollar amount, and then you can get there depending on how many non-highly compensated employees you have. So unfortunately, the credits are not for your sole 401ks. They're more to incentivize providing access to 401k plans for rank and file employees.
Right. So how should a business owner prepare for the upcoming requirements around the auto enrollments, right, and the Roth catch-up contributions?
Definitely start identifying those employees now that will be making more than $150,000 in 2025. And you definitely want to, as you mentioned before, add a Roth feature if you don't have one yet.
Yeah.
You'll want to talk to those employees about if they want to contribute their catch-up as a Roth or they don't want to do it at all. On the auto enrollment, that is for when employees are eligible, they are automatically enrolled in the plan unless they decline. So one thing I've been telling my clients, if they have immediate eligibility, then they may want to think about changing it to quarterly or semi-annually, so you're not doing these enrollments constantly throughout the years, and maybe 2 times a year or 4 times a year, you'll really kind of have to do this enrollment meeting, and you can speak with people if they want to enroll or not.
And that enrollment eligibility is all determined with the plan document.
Correct.
So if you have an old plan document and you've done immediate vesting and vice versa, you can always come back and talk to you about updating that plan.
Correct.
And maybe changing it to
Correct.
12 months of working before you can even be considered a plan participant, right?
Amending the plan is not only for if something in your company changes. Amending the plan could be a good thing to do when new regulatory rules come out. And starting next 2026 into 2027, all defined contribution plans, 401k profit sharing plans, will need to be amended, and new documents will need to be done.
Okay.
Every 6 years, the IRS says that you must do this. So all the laws that kind of have been being passed in the last couple of years will now be in this new document.
And what if somebody doesn't do that?
Then the plan is disqualified.
Disqualified, and all those deductions go away,
Correct.
and everything that the plan was really designed to do goes away.
Correct.
So this is very important to our listeners, that you really should be calling a TPA or your financial advisor, making sure that your plan stays in compliance with all the new regulations. We talked about defined contribution plans. We didn't touch upon defined benefit plans, which is where that cash balance pension plan comes in and so forth. So can you just describe the difference between the defined contribution versus defined benefit plans?
Correct.
And why somebody might want to consider doing a defined benefit plan?
So a defined benefit plan can be used on its own, or it can be used in combination with a defined contribution plan. Something to think about when you are looking at a defined benefit plan or a cash balance plan is if the 415 limit, the limit for the defined contribution plan, is not enough for you. So you would like to make a contribution in excess of 100, 200, potentially 300,000 in contribution from year to year. It works well for people who are getting closer to retirement. That's mostly how the plan was designed. I like to see someone in the sweet spot of maybe in 50s or 60s. Not that it can't work for an owner who's in their 40s or 30s, but it's designed better to work if you're a little bit closer to retirement.
So maybe you've had a business and it's been okay, and now the last 5 years it really ramped up and you're starting to make a lot
Correct.
of profit, and you're like,
Correct.
I'm paying all these taxes, I have all this cash sitting there, don't know what to do with it.
Or your question earlier where you got started a little bit later in saving for retirement, and now you need to kind of catch up to get to where you need to be within the next 10, 15 years of your working. So this allows you to put in much higher contributions. You'll also want a consistent profit year over year. Unlike defined contribution plans where you can decide to not contribute to in a given year, a defined benefit plan or cash balance plans has minimums that you'll want to contribute every year. And if you foresee that you have a defined benefit or cash balance plan and the future does look a little bleak, it is important to get in touch with your TPA quickly to be able to amend or potentially freeze the plan. But that's definitely something you want to think about before starting a defined benefit plan, is that you can hopefully foresee years and years of doing profits as well. And also the demographics matter as well. So a stable, smaller group of employees lend its hand better to having this plan because everyone who's eligible is going to get a contribution. So for it to make sense to the owner, they have to get a sizable amount of the total contribution.
Well, thank you so much for sharing all the insights and your experience. I think a lot of small business owners will see themselves in certain examples that we've talked about today, those moments where too many options lead to procrastination. Like, I just don't know what I'm going to do. There's too many options, so I'm not going to do anything. And they wind up never pulling the trigger. Before we close, if you can give one piece of advice to a small business owner that's on the fence about starting one or maybe amending, what would that be?
Well, as I mentioned before, at the beginning, plans come about from a number of different of different avenues. So really look at your books, really speak with your accountant, and understand if this makes sense for you. I always say, send me a census. Let me work up some of the numbers. I'm a numbers person particularly, so no charge to kind of review a census, show you what it may look like. If it works for you, great. If not, then we'll talk again in the future.
Great. And for any business owner who's said, I got to call Brad, how do they reach you? What's some contact information we can give to them today?
So my email is Brad, BRAD, at Scherer, KLERER.com. And my phone number is 516-409-5500. 5500. Easy to remember because that's the form that we have to sign.
Great. Well, again, thank you for this. I'm excited to share this with all our listeners today. And if you're that small business owner and you missed Brad's contact information, you could also check out the show notes, and we'll list his information there. You could also email us at hello@enrichlifepodcast.com. For our listeners, if there's one thing to take away from today, is that there are experts out there, there are professionals, there are advisors that can help every single one of you. There's plenty of us out there. Don't try to do this alone. It's very complex. The penalties can be extraordinary. Speak to a professional about setting up a retirement plan. If you had one and you haven't really looked at it and you've been ignoring it, there's no better time than today to start looking at this and making sure that you're still in alignment with the new rules and regulations, right? Thanks for tuning in today. I look forward to seeing you again in the future. Please don't forget to like, share, and subscribe. And if you're listening to this and you know a business owner, please share it with them and let them know that we're going to be having a business series on EnRich Life podcast, which will entail a lot more stuff to help small business owners and how they can be more profitable and keep more of the money that they're working hard for. I wanted to say a special thank you to LMC Media and Vectorly, who helped me produce this podcast. Until next time, thanks for tuning in.